With insurance, it's very challenging to have a policy that provides a death benefit and an investment. If you have both of those, if the policy is trying to do both of those, it's not going to work.
And that's because the
cost of insurance continues to go up.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Shawna Theriault. Hey,
Shawna. How are you?
Doing good?
Awesome.
So we're going to start a couple of things. I've heard about this a lot lately. I'm getting phone calls from people saying, hey, I got a call from this insurance person, and they're talking about I can be my own bank if I buy this insurance policy. So I want to dive into that. And you've done all the hard work and the research on this. But something caught my eye a couple of days ago in the Wall Street Journal. And I think it kind of aligns with what we're talking about this episode. It's a great article. It's titled "A Couple Won the Powerball. Investing It Turned into a Tragedy." And so I was like, okay, well, usually people who win that much money, they won $180 million after tax. I think it's like $59 million. I don't know why it was so much less. They didn't talk about that. Usually you think half, you get half, right? But I guess Michigan took a big chunk too in their state tax. But so this couple's in Michigan, they get $59.6 million after tax deposited in their account after winning this Powerball. They realized that the day they won the Powerball was the 5-year anniversary of their granddaughter passing away. She was a 2-year-old little girl, had a rare disease that usually takes babies by the time they're 4 months old. She made it to 2 years old. And they're very religious people, and they said, hey, this is a sign. We need to take some of this money and we need to go help other people who have this disease. So they took roughly $29 million of the earnings and they created a foundation. So that makes sense, right? Well, their financial advisor at the time was a guy with Principal Financial Group.
Insurance.
So insurance, but not much different than Northwestern Mutual, or they're all kind of the same, right?
Sure.
So they're like, hey, this is a lot of money. Do you guys really handle this kind of money? So they said, oh yeah, we can do this. Within a couple of weeks of them winning this lottery, they get flown on a private jet to principal headquarters, and where they're told, we'll take care of you. We have all these people here that are experts in managing this kind of money. Okay. You would think that this is not just grandma who's buying a $500,000 product from him. You think everybody in the whole company would know this. It's making one guy's like career, right? Their advisor. He's never seen this kind of money before. So what happens is the advisor immediately takes, it was $26 million they put into the charity. They immediately takes $18.9 million of their money and places it into an annuity for the charity. So when you think about a nonprofit, what does it do? A nonprofit has a mission. It uses its resources to fund this mission. So however they were funding their mission, a nonprofit, a 501c3 is already tax exempt. That's the beauty of a 501c3, right?
Right.
The reason why you would buy an annuity is for tax deferral growth, right?
Yes. Generally, yes.
So why would you be buying a tax deferred product inside a tax exempt entity? It doesn't make any sense.
Totally.
Now, they could have been buying annuity, had all these guaretees.
Well, right. Because they usually say, sometimes they can act like a fixed income instrument, right? And
correct.
So it's kind of like, you reduce your exposure to the market, even though some of it's tied to the market, and, the guarantees you're talking, but those, you usually pay for those. So
in this case, I don't think it was that kind of annuity. They describe them as variable annuities that had mutual fund like products inside it. So it sounds like a variable annuity. The advisor received $1.2 million in compensation in commissions for that one transaction. $1.2 million. The alternative would have been invest in mutual funds or ETFs. You could done an ETF portfolio that would have had an average cost of 0.03% with that money. Because typically when you have that much money going to an endowment, there's a long runway for you. So you have a long time horizon, and someone else in the family would take over this. It's
perpetual because it's a business. So you have a private foundation. Exactly. So
someone in the family would take over this 501c3, works forever. How long does an endowment supposed to last? Supposed to last forever. So therefore your time horizon is so long that you can just let it ride in most cases and keep some in reserve. And it appears to be that they did keep some in reserve for whatever reason. Didn't really go into that. But the funds, the products themselves had a recurring charge of 2%. So you lost $1.2 million in commissions immediately, and then it had a 2% fee going forward. By 2011, 93% of the nonprofit's assets were all inside annuities. So they bought these initial annuities, and then they kept buying more. And then in annuity world, a new flashier product might come out, kind of like cars.
Sure.
And so you trade the old car in for a new car. So in the annuity world, there's an incentive for these advisors to trade that annuity in for a more flashier annuity. And this guy was doing that. So in the end, $26 million in the foundation, but $47 million was transacted in annuities. $47 million. You had 26. That's over 100% turnover, right?
Yes. Yes.
Or no, it's not. It's just under 100% turnover. But $3.3 million was generated in commissions for this person. So again, this is not, and we see this a lot, especially with elderly and the turnover in the products. But this would be probably the largest asset holder at Principal Financial Group. And they have an advisor who's doing this. So in the end, what's happened is the advisor was eventually terminated, but it took years for that to happen. The family sued. They won a $7.3 million settlement, which is, that doesn't happen, guys.
Right.
I mean, these products are so locked in. You sign so many things. That does not happen. There's some local advisors here in Marietta that we kind of know, and I know kind of the more dirty ones that have judgments against them, which is like $15,000 or $20,000, and they work at Wells Fargo, they work at Edward Jones, So I know these people, right?
Yeah.
And I know how hard it is for someone to keep pushing to get to that point. And I know how easy it is for an advisor to negotiate what's put into the final report, right? Well, to get a $7.3 million judgment is just gross negligence, which the government, talks about in their
the article.
in the article. But it's Pinnacle denies that they're really, that no one has the minutes to the meeting of when they first met, when they were flown in a private jet. Nobody, which that goes back to like client gifts, right? You think that'd be a violation of client gifts?
Maybe, but if you're with them, that,
then they have, you have this family that obviously didn't really, just didn't really understand what was being offered, and they trusted a person. Then you have a company that failed, and that's what the article talks about. There's failed oversight between the company and the advisor themselves.
Yeah.
And so, there's E&O insurance for all this stuff. I'm sure Pinnacle is not going to pay. It's going to pay very little of that 7.3. But the point being is this industry, our financial service industry, gets wrapped into so many different facets of what is a financial advisor.
Right.
And so we have people think that this guy is a financial advisor. This guy was never a financial advisor. This guy is a salesperson who's selling a product. If you're working with an advisor at a Northwestern Mutual, at a financial Pinnacle Financial Group, thank you. If you're working at any of these big insurance companies, MetLife, Mass Mutual, these are not financial advisors. Even if they're a CFP, they're not a financial advisor. They're salespeople. That's how they're regulated. They're regulated as salespeople.
Mm-hmm. Yeah.
Where fiduciary fee-only advisors are real advisors.
Well, they sit on the same side of the table as you, and they're not selling product.
Correct. And you also have this weird world, which is the majority of it, because the majority of people I don't think work at insurance companies. They work at Merrill Lynch. They work at, and that's a whole, they could have product salespeople at Merrill Lynch, or you could actually have a fiduciary advisor at Merrill Lynch in the private wealth section.
Yeah.
So it's very confusing.
It is confusing.
Government has done nothing to be able to level the playing field. The solution is very simple. Product should never pay the advice giver.
Right.
Whatever product you're using should never, ever pay the advice giver. Only person that pays the advice giver is directly from the client. That's how you solve it. It's never going to happen. It's already happened in China, Australia, and the UK. You can't have products paying the advice giver. Here in the United States, it's not that case.
Right.
So only 4% of our industry operates in a manner of which Wiser Wealth does. In fact, we just got an award, expertise.com. It sounds kind of hokey. What is expertise.com? These people, what do they call it? The silent shoppers or the secret shoppers. So there was a prospect at some point that came through our firm that was with expertise.com.
Interesting.
And they were just grading us.
Oh,
isn't that crazy?
Good. No, that's good.
But yeah, there's a list of, I think 14 firms. We're one of them in the Metro Atlanta area. And every one of those firms, I know those people, and I'm like, that's a good firm. That's a good firm too.
Yeah.
That's a good firm.
Yeah.
But anyway, the point is that when you sit across the table from an insurance person, they have one agenda. That agenda is to sell you product. Clearly, in this example, that's what's happening, and this happens all the time, but just not at these big numbers. It happens with everyday people.
Well, and I would like to think honestly, I believe in the good in people, and people who sell insurance, they solve problems with insurance. People that sell stocks, they sell problems with stocks, so right. I would like to think that they, didn't come at it to try to be nefarious.
But honestly, people who only manage assets are just trying to get assets under management.
Yeah. Yeah.
Right. You have to have multiple tools, and you have to set up a company to where there's very little. I think there's always going to be a conflict of interest, but there's very little conflict,
right.
Very little friction between what the advisor can do for you and how they get compensated.
Yeah.
And what's best for you.
Exactly.
But yes, insurance sales has its purpose. People 100%. Need term life insurance.
They do. And there are some places where permanent products, and we're going to talk about that, are appropriate. It just depends on the situation. I've seen it be appropriate when you're doing, I don't know, if you have a second marriage and you want to make sure that you leave this amount to children or a spouse or something, a permanent life insurance policy is appropriate, because you can't get a term because you don't know when you're going to pass away.
It should be designed by a person who's not getting compensated to sell the product. You still have to go pay somebody to buy it in a commission, but the person who designed the strategy should be a person who's not being compensated by that product.
Mm-hmm. Well, that's just the way the industry is. I mean, it's the same thing with mutual funds and brokers, and they have, loads and all of that. So
Correct.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
I had a very nice lady, if you're listening, thank you for your email. She emailed me and said, I should tone down my rhetoric on annuity salespeople. She bought an annuity. Mm-hmm. And she bought an annuity because she didn't like the volatility in the market. And so she basically bought a fixed annuity. She gave them X amount of dollars, and she got X amount of dollars for the rest of her life. And when she passes away, it'll just disappear. And for her, that she felt like that was safer for her.
Yeah.
Now I told her that's her sleeping at night is very important, and she made the best decision for her. But if she had talked to me as an independent advisor, I would have educated her about how the markets work.
Yeah.
We would have created a cash bucket where she would have had 2 to 5 years worth of cash, now paying 5% interest.
Right.
Then she would have had the remaining money would have been in 40% would have been bonds, 60% would have been in stock. And I could show her, most likely, I don't know her scenario exactly, but I could show her that you could basically be your own annuity. You'll never touch the stock. The stock probably gets inherited by the next generation, but you need it to keep up with inflation. You need it for the dividend income. And then you have the bonds, which now have higher yields,
right?
That are generating income into that cash bucket. And now you've just done exactly what the annuity company's doing with your money, except now you get to pass it to the next generation.
And there's upside to it.
And there's more upside to it.
To
and when you get nervous, you call an advisor and say, "I'm really nervous about what's happening." And
then we remind you,
and we
don't
say,
sell.
This was the strategy. This is why you're doing this, right? This is why you got to stay the course.
Right.
None of your lifestyle is not in danger. We've stress tested this thing. If we repeated the financial crisis, your life doesn't change one single bit. And they go, okay. And we saved them who knows what in commission. We're now allowed, the annuity now doesn't just disappear. It goes, you have money that you can transfer to the next generation. But a person who sells the annuity, who solves that problem for her with a fixed annuity, they can't offer you the other alternative,
right? Because
they don't make any money, or they're not smart enough to figure it out.
I don't even think it's just an option at the companies usually.
Correct. Right. Correct. When I started my career off at AXA Equitable in the year 2000, and I could not use index funds. Mm-hmm. I could put an index fund inside a brokerage account, but I would receive $0 in compensation, which means that when I sat down with my manager at the end of every week, I would be chastised for that because I didn't make anybody any money.
Even if it was the right thing to do.
Even if it was the right thing to do.
And that's why you're not there anymore.
I was there for a very short time period.
Right. Because it doesn't sit well. You're not serving people.
Correct. So anyway, I'll get off my soapbox on that. And I'm not going to stop taking these annuity salesmen to task because, and I know them, they're all very nice people. They're in our son's baseball team. They're in our science school class. They're in all these different things, and they're good people. They just have never really thought for themselves, and they drink the company Kool-Aid, and they're just good salespeople. There's people out there that are just really good at selling. You could give them toothpicks and tell them none of these people have teeth, and they could still sell them toothpicks. Right.
Yes. So
there's a lot of people who are good at connecting with other humans, and therefore they're naturally good at moving products. So, again, it's a fault in our industry, and I'll shift it back to whole life insurance. So there's this concept that you can buy a whole life insurance policy, and you can put money into the cash account, and over time, if you needed to pull money out, you can do so. And they tell you that it doesn't cost you anything, or there's no tax involved in pulling it out. Where if you put money into like an IRA, you're going to pay income tax when you pull it out in the future. I have had
both those statements are true.
Yes,
both those statements are true.
They're half truths.
Is there a better way to handle it?
They're half truths. I've had this strategy pitched to our airline pilot clients, saying that they shouldn't save any money into their 401k. They should put all their money into this strategy. I have had a doctor that was told put $5,000 to $10,000 a month into this policy. Don't save in your 401k. Don't put money anywhere else. Just put it into this policy. And it's like this huge solution. So I emailed you and I said, "Hey, Shawna, this keeps popping up."
Sure.
Right. So let's use your CPA, CFP background. And
I'm not a life insurance expert.
Tell me what but we tapped into some life insurance experts.
We did to do this. And it is, the be your own bank philosophy. There's books written on this. And so, it's just really interesting. We're having clients say, what if I wanted to buy real estate or buy something, I can pull money out of this life insurance policy and it's my money and I'm borrowing for myself and it's tax-free and fee-free and all of this. Well, sort of, but not really. And so there's a couple different things. So with insurance, it's very challenging to have a policy that provides a death benefit and an investment. If you have both of those, if the policy is trying to do both of those, it's not going to work.
And that's because the
cost of insurance continues to go up.
Right.
Okay. Now, most agents or brokers don't want to sell you a policy with low insurance because that's how they get paid. That's how the company gets paid. They get paid on the life insurance piece. Okay. So you can structure these, and there's some brokers or agents that do, where the insurance piece of the life insurance piece on the specific product is very, very low. So you're maximizing what your return is and potentially how much you can take out of the policy, and you're maximizing the growth on it because of the cost of the insurance as low as it can be. Okay. So most of them won't structure it that way, although there are experts in the field, if you will, that structure it that way for purposes of the investment and potentially borrowing against it. So just know there's that. If they're trying to sell you both in the same policy, it's not going to work long term. Okay. So I did an analysis and saying, okay, if we're trying to grow, the goal, I assume, of investing into different buckets, if you will, is to grow your net worth.
Right.
Okay. So yes, risk adjusted free as much as possible. Right. And potentially depends on, who you are, but, in looking at growing your overall net worth. So when you create these insurance policies, first of all, in order to draw it tax-free, it has to already be set up, and it has to be something you're contributing to. It can't just be you put a lump sum of $500,000 into this policy and then you turn around and take out $400,000. Right. That is called a modified endowment contract. So the government has gone around that and said, well, you can't have tax-free withdrawal from something like that. That's called a MEC. And so this is something that has to be set up over time. So if you're
like 10 years, 5 years,
potentially, yes. I don't know if there's a time limit on it, to be perfectly honest with you, but it has to be something that is set up and contributing to in order to have that tax-free withdrawal. When you make a loan against your life insurance policy, there is still a cost to that. Now, your investments, your policy is still invested in what it's invested in, but there's still a cost in terms of an interest cost. So if you take a loan, you may be paying them 7 or 8% on that loan. Okay. Which is fluctuating depending on what interest rates are doing. You can do the same thing with a margin loan. So in other words, if you have stocks in an account or mutual funds or what have you, that's at a brokerage account that doesn't have all these other fees that insurance policies have, like the 2% you're mentioning. A lot of these policies have a lot of fees that really hurt your upside. Right. So let's say you have a brokerage account, you can still draw money against that, like a margin loan. If you need access to quick money, you do pay an interest to it, just like you do with the life insurance policy, but you leave your assets invested and there's no cap on your upside. A lot of these policies have a cap on the upside. Okay.
In the whole life insurance policy, when you pay that interest, are you paying yourself like a 401k loan, or you're paying the company?
You're paying the company to borrow.
Okay. So you're not paying interest to yourself like a 401k loan. You're actually paying interest to so they're making more money on top of
right. So I don't know where. Yeah.
It's kind of double dipping.
But they tout it that you can pull it tax free, and like from an IRA you can't. Well, that's true. You can't pull money from an IRA tax free unless you do a loan, and you're limited to $50,000 on your 401k. There's limitations to that.
You could pull money from a brokerage account to potentially tax free.
Exactly. So to me, I'm like, okay, if I have to put my money into this insurance policy that I can't really get a lot of death benefit out of it, or the growth component's not going to be there because the death benefit's going to eat away at the growth. So if I have to invest here, is that really the best investment? Now, they do have an investment component. A lot of times they're tied, depends on what the product is. Yeah. They're tied to an index, and they say, you're going to have downside protection, but they also limit the upside.
The cost of those products is so high, they can't even call them mutual funds. they have to call them separate managed accounts. And the separate managed accounts are going to have fees 2.25% and higher.
Yeah.
Some of the policies I've seen, they charge you 2.25% to get in. And then it's some of a normal like 0.9 or 1% going forward, which is, I think, is ridiculously high for an index fund. But you are correct. So it's kind of like, I guess it's kind of like swimming upriver. You know, your investment has to paddle really, really hard.
Right.
In order to
get that hurdle against the fee
yes.
that's there. Then there's some component of life insurance that has a fee against it. And maybe you've limited that life insurance, but there's some component. It's not usually just an investment product.
Correct. So if the S&P did a 7% year, I would expect that those products, you could probably make around 3, maybe 4, maybe.
Depending on how they're calculated. I've seen some where you don't make anything on that.
Yeah, that's true.
It just depends how they're calculated. If they're a month-to-month calculation or an annual calculation, it depends because they look at very specific timing points in the indexed annuities anyway.
You know, something else you could do. So the whole point is be your own bank. You can borrow money. So if you put this money in a brokerage account, you can always borrow against usually up to 50% of the brokerage account. I've seen it as high as 75%, but you can borrow against your brokerage account. You'd have to get loan approval, but you could always take equity from your home, which probably right now would be anywhere from 7 to 9%.
Right. Depending on what it's for.
You could also pull money from an IRA, which is what they're comparing this to. They're saying, well, if you pull money in the IRA, pay all this tax, you can borrow. If you put the money into the plan, you into this whole life policy, and you borrow money from it, you wouldn't have to pay the income tax. I would argue that if you're trying to build wealth over time, that the tax deferral of the IRA is going to grow to be much, much larger than this whole life be your own bank policy. Right. You're going to get much growth out of it.
Exactly. And that's the thing. And most of the times they're structured where they have so much life insurance, and the people that you talked about, they were like, put all this instead of a 401k.
Yeah.
They wake up 10, 15 years from now and they realize that their account hasn't grown that much.
No. It's only grown by their deposits.
Yeah. And that's tragic. It's completely tragic because you can't recover from that. Right. Is it hurt? Well, you haven't lost money, but you haven't gained money either.
And you wake up 10 years later and you go, how could this happen?
Right.
And you go contact the advisor, and
they can't
if
answer
they're still
the question.
employed, they can't answer the question.
They direct you to the life insurance company, and if you want to make a withdrawal or not.
Right.
Well, and the other thing about these policies and the mechanics is that they're designed so that they last for your lifetime. Mm-hmm. So what that means is, they also sell them as, well, you don't have to pay the money back. Well, that's true. So you could have a perpetual loan, if you will, on that.
True.
But the second you let that policy lapse, all of those taxes are due on that. It's like claws it back and saying that's a taxable thing that you pulled it out. So your death benefit's
going to be reduced by the amount that you owe.
Yes.
Or you could run into a situation where there's not enough cash, and in your older years, the cost of the life insurance is going to be really increasing. Mm-hmm. So the policy become defunct.
Yeah.
And then you would owe the tax on what you borrowed, and you don't have a life insurance policy anymore.
And I know it's being sold as, or talked about as, doing be your own bank to buy investment real estate. And I'm sitting here like, okay, I literally ran numbers to show being extremely fair, giving a return to the returns on the life insurance side versus what you could get in say, a brokerage account, or leaving your money invested there over time. And to me, if I'm doing real estate, leveraging is not always a bad thing when you're doing real estate, when you're doing real estate investment, depending on what the interest rate is and the cash flow, you have to look on the total return of the investment itself. Right. But I'm sitting here going, okay, I can deduct the interest on Schedule E as a real estate property. It's usually a fixed cost that I know what it is. Whereas if you're pulling from a life insurance policy, not only is the assets that are in there really limited on the upside overall growing my net worth, but then that's a floating rate too,
right?
And where do you deduct that? Maybe you can deduct it, but I would think being able to get a deal and understand the parameters of what your total return on the investment is, I would want to know those costs going into it. And I wouldn't want to hurt my upside to be able to borrow. Now, the articles that I saw online about this, they were like, well, if you have a credit card paying or charging you 24%, maybe you should borrow from your life insurance policy to pay that off. Oh, okay. Yeah, I guess that would make sense. But to me, if someone has that much credit card debt, they don't need to be in a life insurance policy. And I'm
not that life insurance policy.
No. And I'm sitting here also thinking, as a professional that's been in the industry the same as you, I wouldn't want all my money in a life insurance policy. I wouldn't want all of my money in a retirement account. I would want a mix of both retirement accounts and brokerage money so that I have options in retirement, so that
right.
Correct. Every time I pull something out of a retirement account is taxable. So it's great to have a mix of both, but I wouldn't want it tied up in a life insurance policy where I don't have control over that.
Right.
Yeah.
In their illustrations, they always use these extreme examples. Like, it's better to borrow from your plan than it is to use a 24% credit card. I'd say if you have to use a 24% credit card,
right, you need a new plan.
You need a new plan. Exactly.
I mean, but everyone has life happen, and I get it, and it gets confusing on right. what to do.
I saw that in the MetLife is offered. I know Delta Pilot's a GVUL policy, and I saw it in their brochures. It makes sense from a tax component to use that only as like the last resort, like you've gotten everything else taken care of. But their examples were extreme. And then when it came to the cost and growth of investment, there is no chart or anything to be found because it's ugly. It doesn't look good.
Mm-mm.
So the only way that a policy like that would work is if you're able to defer money into it and you're saving, you're in the 37% federal tax bracket plus, your state usually 5, 6, 8%
right.
from where you live. That's where it starts to make sense after you've done a whole laundry list of other things. But you read these brochures, you talk to the people on the phone, and they give you these, either they don't answer the question because it's bad for you, or they give you these extreme examples.
Well, maybe the extreme examples are the only time it works.
Well, no. That's my point.
Yeah.
Yes, that's the only time it works.
Okay, it makes sense in this one scenario, and that's true of a lot of things. Or maybe they give extreme examples just to differentiate. Because why would you go through all of this if it's very small margin of return?
Correct.
Which is the answer.
Correct.
It's such a small margin of return, and usually it's not a good return.
Again, some positives to maybe doing a strategy like this. Typically it's people that already have a lot of assets.
Yes.
So for example, we see this all the time. You marry somebody 10, 20 years younger than you.
Yeah.
It's crazy. The 20-year part. But you marry someone who's 20 years, you fall in love with who you fall in love with, right? So you're going to be dead a long time before the spouse is dead, most likely, statistically, right?
Right.
So you could purchase a whole life insurance policy. So it allows you to spend down your assets in your retirement comfortably, knowing that there's this policy over here that when I die, she's going to get a new, or he is going to get a new influx of cash.
Right.
Okay. It's expensive, super expensive, because you're typically not doing it till you're older. But that's where a strategy of a whole life insurance policy makes sense to me.
Or for estate planning.
Or that your estate's going to be paying $500,000, $1 million in estate tax. So you go ahead and purchase a policy now because you're buying it maybe 50 cents on the dollar. So when the tax has to get paid, this policy pays the tax. And then the flip side of that is maybe the family assets don't have to get sold. So if you have a lot of assets that are physical homes, things that you don't necessarily want to sell, then policies like that start to make sense. It's the everyday people that think that somehow this is a life hack, a financial life hack, to be able to buy something like this, and they're smarter than everyone else. And the reality is that no, you just got duped by a guy or gal who gets paid a commission to sell a product. That's the reality.
Yeah.
And they have a very compelling story pitch to sell their product, because they can talk about, I guarantee. Right. I can also guarantee them they won't make any money, but
yeah. If something has a guarantee, it's probably a very small guarantee.
Yes. And how do you think the insurance company makes money? They make the money by taking your money and throwing it into something like the S&P 500 and investing it, knowing that over time they're going to come out just fine, pending a 2008 or something like that, right?
Mm-hmm.
And therefore,
And then they go under.
Right, they just get bailed out, right?
Yeah. But they can go under.
So yes, yeah, as we've seen. So yeah. Anyway, I think the point of this whole exercise is be your own bank by buying life insurance. It just doesn't make sense unless you fall into a category of what we just talked about.
Right.
And I think for a majority of our listeners, that's not going to be the case at all. Or it's too late. You're in your 70s and it's just not affordable to buy $1 million whole life insurance policy. But yeah, you just got to be careful. I mean, everyone has a pitch. Everyone's trying to sell you a product to benefit themselves and their family. And you have to figure out what the pros and cons are of the product separate from them. They're not advising you. They're selling you.
And just understand what it is. Try to understand. They're all very complex. Understand what you're buying.
It's no different than walking into the Ford dealership. You know what to expect then. You know, this guy's trying to sell me a car. I want a car. He's trying to sell me a car. I don't know if this is the exact car I want, but he's not going to tell you at Ford, if you're buying new, he's not going to tell you, you know what?
These are in the shop every day and they're breaking down.
Right.
Don't do it.
Go talk to the service department. They'll tell you that. But you know, they're not going to tell you, go talk to Toyota. I think that Tundra is a better fit for you.
Right.
No one's going to say that.
No.
You're going to sell the product that is sitting in front of you. And a lot of these salespeople will say, well, I can offer my product, but I can also offer all these products over here. But in the reality, they're getting compensated more for moving their own product versus these other products. And it's probably disclosed somewhere, but you're never going to find it. Some deep in the fine print, some form that you signed.
Yeah.
So anyway, thank you, Shawna, for researching that. I think that's very important for our listeners to understand the conflicts there. And most likely this is not a viable strategy if you really are trying to build wealth.
Right. If you're trying to get the best return, it's probably not the best way to structure it.
Probably not even the best way to borrow money.
No.
So there's a lot of power to be had in a large brokerage account.
Yes. You can borrow against it. You can make withdrawals that are tax-free. You can, you can just...
you can tax loss harvest it and create credits on your tax return.
Yes. You can gift appreciated securities to charity.
Indexing.
Yes.
You can gift securities to the next generation.
Yes.
Yeah. I think that's the key takeaway here is stay away from these, what you perceive to be shiny objects. Just go build a big brokerage account.
Well, a lot of clients, and I understand this, they're like, well, I have to put it in an IRA or it's not invested. And it's, but really, I mean, I understand because we always talk about deferring to 401k, put it in retirement. So they think it's a retirement account, which it can be used for retirement, but a brokerage account can still have the same investments that a retirement account can have. It's just a type of account. It's taxed a little bit differently, but you can invest there. Yeah. And some of the, new people coming in or have only used a 401k, they didn't know that. So they have banks and they have 401ks. They don't have a brokerage account.
We call them opportunity funds. We have lots of episodes on opportunity funds.
Exactly.
So, all right. Well, thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com. You can also click on the link in the episode notes. We do have a few episodes you might be interested in. Number 214, what is disability insurance and do I need it? Long-term care insurance, to buy or not to buy. Episode 179, episode 146, the power of life insurance to meet your family's goals. You can also check out our YouTube channel, also called A Wiser Retirement. Long-term care insurance explained is one that we have linked here. Thanks for listening. If you have an opportunity to like and subscribe to our podcast, please do so wherever you're listening to the podcast. Have a great week, everybody.